Hello, it's Travis Hornsby, and I want to wish you Happy New Year. I hope that your holiday season was not as stressful as mine. We had a close contact, and then we had to get tested, and it was just a real nightmare. I think that my wife said that some people were waiting 5 hours in line to get tested, so goodness sakes. Hopefully 2022 is a way better year than 2021. Of course, we said that last year, but I want to focus on the positives. 2022 will be different. It will be different than 2020, than 2021. We just don't know how yet. But 2022 can be the year that you take control of your financial life and get to the path towards financial independence. I want to talk about this because this is really important. We talk about student loans in this show, right? That's the focus of Student Loan Planner, is to solve student loan anxiety and eliminate that anxiety for borrowers, especially those with the highest balances. But even if me or one of the team at Student Loan Planner does an amazing job just blowing it out of the water with your student loan plan, if you don't have a plan for investing, then it's not all for naught, but it doesn't really fix the problem. Student loan debt, if you eliminate it tomorrow, will not make you happy. That might sound crazy. A lot of people would say, Travis, you're nuts. This would be amazing if they eliminated it tomorrow. But the problem is you would still not, most people would not have financial independence. You would still have no choice but to work for an income. Now, I'm not saying that that's a bad thing. That's a good thing to have purpose and meaning in your job. But what I do think that people want is freedom. In a year where we had the exact opposite of that, of lockdowns, of just the virus spreading everywhere, of just not feeling like we can gather with family and friends and go out and do our normal things. We love freedom as human beings. We want to have agency. We want to have choice over what we do, over our working conditions. That's a really important thing for people. So how do we get choice? How do we get financial freedom to live the life that you want to live? The answer is through investing. So real quick, I want to kind of show you a little bit about the markets in the first part of today's show. I want to talk about how unpredictable they really are. Because if you think about what's happened the past 2 years, it really doesn't make any sense. And it shows you why even the smartest experts predicting what's going to happen really have no idea what they're talking about. So let's think about 2020. So I actually remember the very beginning of 2020 because it was my 30th birthday. I went out with my family, my parents, my wife's parents, and a couple close friends and my brothers. We went to New Orleans and we had an amazing celebration in January of 2020. Goodness sakes alive, did I have no idea what was coming. Obviously, we had heard about this virus coming out of Wuhan at that time, but we kind of assumed that it was going to be just like that SARS scare in the 2000s. It was just going to be a lot of, fear in the media and everything, and then it was just going to go back to normal because these things happen, right? How many times, be it swine flu, bird flu, etc., that do we hear things, mad cow disease, right? We were all used to hearing all these things on the news and just them amounting to nothing. Then suddenly it didn't. So in 2020, we had lots of deaths from COVID. We had deaths from all kinds of other things, people not getting medical care because they didn't catch certain kinds of cancers or getting care for heart attacks or heart issues, right? You had higher deaths from overdoses in 2020. We had the reckoning with protests for racial justice after the murder of George Floyd. We had mental health problems. We had the lockdowns. It was a really rough year. So what would you guess the return was of the stock market in 2020? Guess what? It was 16%. Now that masks a rather extreme move in the stock market in 2020. If you recall, back in March, the markets crashed, and they crashed like 30% over the course of about a month. It was insane. It was terrifying. It reminded us of 2008, but accelerated. A lot of companies were on the path to going bankrupt, and then the Federal Reserve backed the truck up and just said, you get a loan, and you get a loan, and you get a loan. And then suddenly overnight, yields on things like Carnival Cruise Line's debt went from double digits, basically predicting their demise, to a single digit interest rate. All of a sudden, financial markets just snapped and just went on a tear. Even though 2020 was this miserable, awful year, the S&P 500, which is an index that measures the broad U.S. stock performance, returned 16%. So the stock market did great in 2020, Well, then how possibly could it have done in 2021? Because let's face it, y'all, 2021 was even more frustrating and potentially even more devastating than 2020, mainly just because we thought we would be over it. We thought we would be done. We had more COVID cases in 2021 than we did in 2020. We had more COVID deaths in 2021 than we did in 2020. We had shortages, soaring housing prices. Childcare was next to impossible to keep and find, and the constant quarantines and distance remote learning and all the stresses of not being able to, again, go out and travel. And the worst part, too, is we had that gorgeous, brilliant summer of 2021, right? The hot vac summer. Hot vac summer lasted for like 1 month. And then we had July 4th. And then we had the CDC reports talking about how, well, actually, maybe vaccinated people could spread the virus because of Delta. And then we had a return of a lot of the restrictions locally here where I live. They've had, mask mandates since August and still have not lifted them yet, right? So we had all these returns to a just sort of something that looked more like 2020 than what we were expecting with vaccines in 2021. So you would think with all those strains and stresses that the stock market probably did really badly. What would you guess the return of the stock market was in 2021? Was it more than 2020 or less than 2020? If you answered more, then you're correct. The stock market in 2021 did approximately 27%. So 16% in 2020, when you had a miserable mass pandemic just wreak havoc. And then in 2021, that pandemic wreaked even more havoc, and we had a 27% return in the markets. That's crazy. Now, if you think about the bond market, you might say, well, why do I care about the bond market? Well, it actually is really important. It determines what interest rate you're going to pay on your mortgage. It determines what interest rate you get on your student loans if you refinance. It determines what interest rate you get on your car loan, a whole lot of things. So bond market returns are actually pretty important, and interest rates are extremely important for your life as a consumer. So if I said that in 2021, inflation was going to be the worst in 40 years. It was going to be 7% inflation. And keep in mind, in 2020, interest rates were in the 1.5% range. What would have happened to the bond market, would you have expected? So just so you know, when yields go up on bonds because of bond investors wanting more yield because of inflation or something like that, prices on bonds go down. So for every 1% increase in interest rates, bond prices might go down 5 to 10% if it happens instantaneously. I won't go into the details as to why that is. Just know that's kind of a rough rule of thumb. You might say 5% would be a sort of a good estimate. If you think about 7% inflation, well, you would have thought, oh my gosh, like bond prices probably fell 30%. Instead, in 2021, bond market prices went down negative 1.7%. In other words, the interest rates on bonds didn't change all that much. Why? The one big reason is the Federal Reserve, which is the central bank of the United States, continued buying $120 billion of bonds. That's a lot. And the bond market is something that's been very much supported and sort of propped up, if you will. But we have no idea what's going to happen in 2022. The Federal Reserve has signaled that they are going to slow down their purchasing of bonds and try to back away from supporting the bond market as much as they have, because they're concerned about inflation becoming persistent. And inflation becoming persistent is a huge economic risk. If you have that happen, then that's a big risk factor for 2022 and the economic recovery. So we might see interest rates go up and go up significantly in 2022. But what we've learned from 2020 and 2021 is we cannot know that. We don't know if the stock market in 2022 is going to have another stellar year, and the 2022 year is going to be like the late 90s, where the stock market looked pretty overvalued in 1997, but then it kept returning 20 and 30% for another couple more years. Or will it look like 2000, where you had a string of double-digit negative returns for 3 years in a row? I've got 3 positives for investing in 2022 and 3 caution signs for investing in 2022. And I want you to just think about how that applies to you and your financial goals. The first of the three positives for 2022 that I've got is that you have a multi-decade horizon. If you're listening to this, there's a good chance that you are a younger investor, 20s, 30s, maybe 40s, and that means you have a long time to invest. So if anything, what you would want to have happen is the stock market to crash, because then you would be buying a lot more share of ownership in companies for a much cheaper price. You have a great education. You have a more stable income than the average American. That stable income means that you're going to get paid and paid a decent amount of money, probably no matter what's going on in the economy absent a Great Depression, which means that when other people that have incomes that are more sensitive to the business cycle, their incomes are going down, your income will be pretty stable. And that means that having an automated investing plan that's cognizant of what you need to do long-term could really transform your life if you're listening to this. You want to take the asset that you have, which is your brain and your high earning power, from that brain and that education that you invested in it, and take advantage of that. Take advantage of a regular automated investing plan. And there's something called Harmonic Mean. Harmonic Mean is, you might have heard of like arithmetic mean or geometric mean, right? Where you just say, okay, what's the average if you have 1 and 2? What's the average of those two numbers? Well, 1 plus 2, is 3 divided by 2 is 1.5. There's this cool concept in investing called harmonic mean, which simply says that if you invest regularly with an automated investing plan, then what happens is you buy more stocks when things are beaten down and fewer stocks when things are really expensive. So as an example, maybe let's say you buy $20 worth of gas at 2 separate times. At one point, the first time that gas is at $1 a gallon, and the second time gas is at $2 a gallon. If I said, what's the average price you paid per gallon of gas? A lot of people would say $1.50, because you would say $1 plus $2 and divide by 2. But that's not correct, because you spent $20 when gas was at $1 a gallon, so you bought $20 of gas. And then the second time, you bought $20 worth of gas when it was at $2 a gallon, so you bought 10 gallons of gas, right? So if you look at the total amount you spent, it's $40, and divide by the total number of gallons of gas you bought, it's 30. The average price paid is actually $1.33. Now you might say, well, I always need the same amount of gas. What are you talking about? Because if I'm on empty, I'm going to fill it up with 15 gallons. That doesn't make any sense. Well, okay, it's just an example. The good news is when you're investing, obviously that applies, that concept where you can buy as many shares of stock, if you will, as you have money that you're investing at the time. And what happens is over time, that average price paid is a lot lower than you think it is, because you're just consistently, regularly investing. And over a multi-decade horizon, I can tell you this, I have no idea what stocks are going to do next year, but I know that for the next 40 years, stocks are going to go on a tear. They're going to beat inflation. They're going to raise significantly over time. And the reason is because we have a dynamic economy that continues to grow and continues to be the beacon of the world and really the envy of most countries abroad. Really, if you think about it, stock market returns come from gains in productivity, growth in corporate profits, and frankly, from not having a world war. That's sort of the one way that a stock market can truly crash past the point of returning, is if you lose a world war. Historically, that's pretty much the only way that you don't have exponential returns in the stock market. So absent that, the next several decades for the United States look fantastic in terms of investing. So positive point number 2, you have a multi-decade horizon. Positive point number, that was positive point number 1. Positive point number 1, multi-decade horizon. Positive point number 2 is knowing about tax loss harvesting. So if 2022 has a drop in asset prices, if 2022 sees a drop in the stock market, you should not despair. You should be thrilled. And the one reason is because with this regular investing plan that I hope you have in place, you will be growing your assets much faster than you would if the stock market was going up. Now, the other benefit if the stock market's going down is if you know about tax loss harvesting, what you can do is save thousands of dollars on your taxes without actually losing money. So the way that this works is if you're regularly investing, what you can do is you can stop investing in one particular mutual fund, sell that mutual fund, and buy something that's similar but not identical. So for example, there's a fund at Vanguard called VTSAX. It's the total US stock market index fund. There's another fund at Vanguard called the S&P 500 Index Fund. Those funds have a correlation of performance of like 99%, but they're not technically identical because they follow two different indexes. So you can sell one fund and buy the other, wait 30 days, and then switch back into the fund that you were originally in. Now you might say, why would I do that? Well, if you have a decline in your investments and you do this trade and then you do the trade 30 days later, you can lock in losses that you can use to offset income that you're earning. It can lower your taxable income. It can save you 30, 40% in taxes up to $3,000 a year. And if you have additional losses beyond that, you can carry them forward into future years. So that's how I've generated 5 figures of losses that are on paper because the stocks went way up long term. But on paper, I've got these 5 figures of losses that I'm able to use to offset any of my gains as well as $3,000 a year of my income. That's something that makes investing in 2022 a win-win because either you have the stock market continue to go on a tear or you'll know about tax loss harvesting and you'll know how to implement that in your portfolio, or you'll at least be able to identify a company that does do that for you. So a big part of learning how to invest is that if you know the concepts, you can ask smart questions. I have a CPA. I theoretically could do my own taxes, but I have no interest in doing my own taxes because I want somebody who's extremely familiar with it and who specializes in it. But because I'm an informed consumer, I'm able to ask my CPA good questions about why would we elect a C corporation versus an S corporation? Why would we be maximizing this deduction versus that deduction? Why would we be setting up this kind of retirement plan versus this kind of retirement plan? A big part of investing is knowing the right questions to ask. The third big positive for investing in 2022 is that you have a great opportunity to invest in yourself. So if we think about the labor market right now is on fire. And there's a simple reason why. There's a big chunk of people that are obviously afraid of getting the virus that are trying to minimize their exposure and stay out of labor force for those reasons. There's childcare issues preventing both women and men from being able to work full time because they have childcare responsibilities that they're not able to find reliable childcare to watch their kids. We have workers that have a lot of savings that don't need to rush back into the workforce in a suboptimal job. We also have more mature workers, older workers that have suddenly looked at their home equity values and noticed that they're higher than they ever dreamed that they would be. And they have really solid 401ks as well. And so why would you work in a stressful environment right now in any kind of a client-facing or service-oriented job when you could simply just hang up the hat and retire? So you have a lot lower share of workers in the workforce. And what does that mean for you? Well, if you invest in yourself by either negotiating for a higher wage in 2022 or potentially trying to start your own business, the returns could be exponential. And when you take those additional returns that you get from negotiating or from starting your business, you'll have even more capital to invest in 2022. One thing that I have noticed with our clients is that the rate of return doesn't matter too much. It's a lot more about your contribution rate. How much are you saving? How much are you putting away? You can increase your contributions a very small amount and even have bad market returns and still end up in a great place. So a lot of people don't realize they have leverage and they just accept whatever small raise that their employer is giving them. So I would highly suggest that you think about that for your own self. Invest in yourself in 2022 by asking your boss or asking your company for a significant raise, potentially switching companies to a new company for a much higher raise. That way you don't have to worry about, negotiating. You can just negotiate with someone else and take a new job, or you can start your own business. And we've got a lot of people doing that because we've added a practice loan bonus program, kind of like our student loan refinance bonus program. So on our studentloanplanner.com site, you'll see this in the marketplace section of our menu. You'll see private or practice loan financing, and we're giving up to $1,000 cash bonus when you finance or refinance your practice debt through Student Loan Planner. We're seeing a lot of people take risks like that. We're seeing a lot of people start their own businesses and start their own practices. And if you can't find a practice to buy, we're seeing a lot of people just start their own. So here's some risks, 3 risks for investing in 2022. Risk number 1 is the valuations in the stock market right now are the most extreme they've been since the dot-com bubble. So in the dot-com bubble, the peak market valuation was about 44 times earnings. The current valuation of the stock market is about 40 times earnings. So that's only 10% lower than the all-time high. The 40x valuation level of earnings right now is higher than it was in Black Tuesday in 1929, when it was only 30 times earnings. That's extremely concerning. 40 times earnings. Why would this be? Well, we have a lot of cash floating around out there. There's not a lot of places to spend it. There's not a lot of fear right now. We're in this market cycle where it's all about greed. Because if you think about it, if you had any fear at all in the market, would people be investing in cryptos they never heard of before because they think they're going to pump and dump them? Absolutely not. Would investors be excited to put a ton of money into questionable companies with no path towards profitability just because they have good revenue growth or good user growth? No, they would not. So we've got extreme valuations right now. There's good reason for it, actually. If you look at bonds, bond rates right now are 1.5%. In the 90s, during the dot-com bubble, they were much higher. So bonds were a much more attractive investment in the 90s, which makes the valuations of the 90s even more extreme. Today, you could simply say the stock market is very highly valued because all the other options out there are really not that great. So that's why the stock market's highly valued. Again, what you could have happen is companies could continue performing really well. The economy could do just fine, but valuations of the stock market could decline to more normal levels, and that could alone be responsible for a 20% drop in the stock market. So that's definitely a big risk factor for investing in 2022 is extreme market valuations that are among the highest ever. Number two big risk. So number one big risk was extreme valuations. Number two big risk for investing in 2022 is scalding hot inflation. So we haven't seen inflation of this level in a long time. So the past year, 2021's inflation was about 7%. That's the worst inflation that we've had in 40 years. So if you think about investing, well, if you have 7% inflation, that like a long-term stock market return, is around 10%. That's like a really good annualized rate of return on a nominal basis. So if you got 7% stock market, or if you got 7% inflation, that is telling you that the economy is way out of whack. The Federal Reserve, the central bank, they target 2% inflation to keep prices stable. And if you think about it, it makes a lot of sense. If you are a business and you are in the business of, let's say you're a veterinarian and you charge a certain amount of money for, procedures or something, and then suddenly you get notice that your medications that you prescribe for the patients that you treat go up 10% in price, you have to pass that along to consumers or you have to take way lower margins. So eventually businesses pass along higher costs to consumers in the form of higher prices. But then those higher prices mean that people's standard of living goes down. And so then they ask their employers for higher wages, and then the employers have to give them. And then you just get into a vicious cycle where everybody starts expecting prices to soar. And so everybody starts rushing to buy stuff now instead of later. And the increase in demand causes prices to get even more out of whack because everybody is afraid that if they don't buy it today, the price for that asset's going to be much higher tomorrow. And then you get into a vicious cycle. So this is what happened in the 1970s. In the 1970s, we had out of control inflation and out of control inflation expectations, and it was really wrecking the economy. And it's one of the big reasons why Jimmy Carter lost the election in 1980. So this is a very big risk to the economy. And it's one of the reasons why the stock market, I believe, crashed like 40% in the early 70s because you had this out of control inflation that was really running rampant. And the person who tamed that inflation was called Volcker. That's his last name. He was brought in and really brought the economy into a deep recession to stop inflation expectations because they had basically had to because they were so out of control. So that would really stink. And that's one thing that the Federal Reserve is trying to avoid is creating a recession specifically to stop inflation. Because if you don't stop inflation, you can have just a runaway economy that's really bad for everybody. So inflation's scalding hot. So if the Federal Reserve overcorrects for that, there could be big drops in investment prices and big declines in the return of fear in the market. Number three big risk in 2022 for investing is extreme speculation. So I have seen so many posts on social media from people that I grew up with that are talking constantly about investing that never ever would normally talk about investing. That's a big risk factor. There's a quote that's attributed to Joe Kennedy, who is the father of John F. Kennedy. Joe Kennedy Sr. is the guy that sort of bankrolled his children's rise to political stardom, and he made a ton of money in the Great Depression, basically shorting the market. One of the things that he's famous for is saying, when your shoeshine boy is giving you stock tips, it's time to get out. You might be like, well, what's a shoeshine boy? Because none of us get shoe shined anymore in 2022, right? We don't have anywhere to go. We don't have fancy shoes that need to be shined, I guess. So you might be like, what's that? But I mean, what he's saying is sort of like when somebody that is like working class person that's normally not involved in the stock market suddenly has a lot of opinions about it, that's showing you that the greed emotion that runs rampant in the market, the other emotion is fear, and they're always a tug of war between these two, right? Right now, it's the emotions are all greed. And what that's bringing out in people is this desire to get rich quick. And when you have a desire to get rich quick, what do? You don't put money into long-term good investments. You put it into speculative things that could double tomorrow because that's exciting. YOLO. The thing is you only live once, but you also only live once. And if you lose a lot of your money gambling on something like that, then that means you're going to be working for a lot longer. And I predict that's one thing that's going to happen once the disruptions of the pandemic economy are fully past, is you're going to see a lot of these speculative assets pop. Not to say that the stock market is necessarily going to pop like this, but a lot of these random cryptocurrencies, just stuff that people are just throwing money in, your Dogecoins of the world, these sort of joke things that are soaring in value. Those are the things that you really need to be careful about. I mean, and you can also even see some extreme speculation in actual blue chip companies too. I mean, the value of Tesla, Google has absolutely soared. There's good reasons for that. But at the same time, you could easily see a world where those companies come back to earth as well. So you need a plan. In the face of all these challenges for 2022, you need a plan. And I want you to think about having student loan debt. There's really two scenarios, right? You either need to pay the student debt off, or you need to think about it like an income tax. Either one of those two paths definitely is a solid path to getting you out of debt. So once the debt is handled, what is your number one financial obstacle towards living the life that you want? It's actually having a lot of assets instead of having debt, because I've never seen a debt situation that's not manageable through a good plan, right? Maybe refinancing it to a 20-year fixed rate at 3%, or treating it like an income tax and putting a couple $100s away a month in investing accounts for the tax bomb and thinking about it like an income tax, right? You can figure out the student debt. But the problem is that people don't know how to get to a six-figure net worth. And when you don't know how to get to a six-figure net worth, you're not going to reach the seven-figure net worth that will give you enough passive income to fully replace your professional active income. That's the big problem with investing right now for young professionals. That's why we made the only investing course out there specifically designed for professionals like you that have a large amount of student loan debt that need to know how to reach six figures of assets. That's six-figure debt to six-figure net worth. This course, we've updated it 7 times since 2019. And if you bought it when we launched it in 2019, you'd be up about 70% on your money right now. Although, of course, past performance is no guarantee of future results. But performance is not the reason to make 2022 the year that you invest in your investing knowledge. Having a long-term plan is what's going to get you to escape velocity towards financial independence. In other words, going to the moon, that can be your financial future instead of the price of any particular speculative asset. The way you get your assets going to the moon is you identify what kind of tax-deferred accounts you have. You learn about tax loss harvesting. You learn about brokerage account investing. You learn how to contribute regular automated contributions to investments and where each of those funds should go. You learn about whether you should pay down debt or invest. You learn about what different kinds of stock market funds do, what they are, what they represent, and what kind of realistic return expectations you should have. So remember that the most important challenge you have is not your student loan debt. It's the fact that maybe you're not at the point where you have a mid six-figure level of assets. Once you've reached 6 figures of assets, you've really figured out enough that will get you eventually to financial freedom. But before you get there, it's a real challenge. And we know this because if you look at one stat, the Transamerica Retirement Center did, median retirement savings is only $172,000 for people in their 60s. So if you take about 4% of that, that's not enough to live on. That's like $8,000 a year of retirement income. And that's just people with retirement savings. So many people do a bad job of this because they just don't have the knowledge. So if you hit 6 figures of assets in your 20s or 30s, your net worth is going to be on track to be in the millions when you retire. And instead of having to wonder if you're going to have financial security, you'll be virtually assured of it. So that's why investing now is so important. And remember, in 2022, it's a win-win if you start investing and learn how to invest right now, because you can either afford to invest and you're going to watch your financial future rocket upwards with high stock market returns, or you're going to watch it rocket upwards because you'll be buying a lot of extra stock at cheap prices if the market crashes, and you'll save a lot of money on taxes through strategies like tax loss harvesting. 2022 is the year that you can absolutely transform your life financially. It can be the year that you put yourself on the path to have enough passive income to not have to work a lot faster than you ever dreamed possible. So if you have already bought the course, the 6-figure debt to 6-figure net worth investing course, go check it out again because we've made a lot of updates. And if you have not yet bought it, it's our best and most important product at Student Loan Planner, even more important than a lot of the student loan planning that we do, because it teaches you how to get to financial freedom. The student debt monster is this cage, if you want to think about it, that holds you back. And what we help people do is break those chains on that cage to let you out of it so that you can have choices in life. But once you have those choices, now you need to fill your rocket ship up with liquid oxygen so that you can ignite that and send your financial freedom higher like a rocket ship that fast. And when you're young and when you have a professional income, when you have a lot of life ahead of you with a more stable income than your peers because of that education, you have a tremendous asset, but you need to monetize that asset for yourself by learning how to invest. And the gambling and the sort of YOLOing of investing that's going on right now is not going to be what's going to get you there in the long term. You need to know how to invest the way a CFP or a CFA or a professional investor would invest, not how some random person that gambled and hit it once is investing that's telling you to go copy them on YouTube or social media, because that's not how you can sustainably invest for the long term. If you're interested in learning more, we're going to drop the biggest discount we've ever done on our investing course. We're going to drop that next week. But if you want to check it out, you can go to studentloanplanner.com/investing. I hope a lot of you will consider taking this course, and there's a 7-day money-back guarantee as well. So think about that you're either going to save thousands of dollars with this course very quickly, or you can just simply write us and ask for a refund. studentloanplanner.com/investing. I wish you a happy new year. Let's make 2022 the year that we all had a lot better life and that we all got our financial freedom on track. Thanks, everyone.